and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Nvidia is just a beast. And, you know, when you look at the progress that they've made, 100% plus revenue growth, 100% plus earnings per share growth, and they just have huge advantages over competition right now. We think that the secular trends and demand for AI, generative AI is just there, absolutely.
So all the guys around the table, Donald Trump himself has got his own coin and was an NFT issuer. All the guys around the table like our space. They believe in the digital asset world. They believe in blockchains and in Bitcoin. And so the whole energy of this administration is going to be so different than the Elizabeth Warren, Gary Gensler era.
I think it's more worrisome for Target specifically than for the overall consumer economy. There are other retailers that are actually doing a little bit better than expected in this environment. So it does feel like the environment is weighing on Target, but in addition to that, there does seem like some company-specific issues here as well.
We got 1 hour to go until the market close. So let's take a look at the major averages on this Nvidia day for those who celebrate, and that's pretty much everybody. We've got the Dow down about 50 points going into that report after the close, about 0.1%. The S&P off about 0.5%. Oh, we're a little glitchy there. And about 0.75% decline for the Nasdaq here today. You know, a lot of our attention is, of course, on Nvidia, and those shares are off about 1.8% going into the close. Whoop, going to go off of that and just look at our big, beautiful heat map.
You know what, Julia, you're absolutely right. Let's not complicate it. It's Nvidia day, right? It's earnings. We're all on pins and needles. It is the world's most valuable company. I think, you're waiting to see whether they can continue what has been an incredible run. You're waiting, what do they report? What do they guide? What does CEO Jensen Wong have to say? I mean, everybody will be hanging traders, investors on his every word on the conference call. And then more broadly, you're just kind of thinking through what could potentially be the impact, at least short-term, directionally for the market as well.
Yes, definitely. And maybe investors are perhaps savoring a little break from the fire hose of news out of Washington. And, the chance to focus on something else.
Who knows? Yeah, the day's young. I mean, we got a lot
to go. The day's young. I know. I shouldn't have just jinxed myself there, should I? But in any case, and then after Nvidia, there's not another sort of obvious catalyst on the calendar until we get to the Fed meeting in December. So that's something to think about as well. All of that said, got to sneak another peek at what's going on in the crypto market. Let's see if this chart works for you. Yes, it does. Bitcoin magic strikes for the chart, at least above 94,000. Earlier touched a new record high again today as we continue to see that momentum behind Bitcoin on day 2 of options trading that started tied to Bitcoin ETFs.
And by the way, speaking of Washington, you saw these headlines. Maybe a new crypto czar of some kind could be coming. Who knows? We're going to talk about that too.
Yes,
with Nvidia gearing up though to report those third quarter results, a crucial litmus test for the AI trade. We're looking at what investors should watch for with Yahoo Finance's very own Dan Howley. Dan.
Yeah, Josh, we're looking for a number of big themes here. Let's just break down the numbers real quick of what Wall Street's anticipating versus what they had in the same quarter last year. So Wall Street's looking for earnings per share of 74 cents on revenue of $33.2 billion. That would work out to an increase year over year of 83% on both the top and bottom lines. That's where they had reported 40 cents EPS and 22.1 billion on revenue. The data center segment, the most important segment overall, is expected to bring in $29 billion for the quarter. That would be a 100% increase versus the 14.4 billion they reported in Q3 last year. And then gaming, because this was a gaming company, is expected to top out at $3 billion. That's a modest 7% jump over the same period last year of $2.8 billion. The big things that people are going to be looking out for, obviously, are the outlook for Q4, their fiscal Q4, and then what is going on with Blackwell, and if there are indeed any larger delays than have already been announced with regards to shipments to customers. And so that, I think, is going to be the single biggest portion of the investor call. Investors are going to be asking, okay, we've seen Michael Dell tweet out an image of a server rack running with Blackwell chips. I believe it was 72 servers. We know that there were potentially these issues with overheating. Is that going to slow down things more? NVIDIA had released a statement saying this is all part of the normal build out and getting servers into different companies' systems. So it's kind of basically a normal occurrence. But does that mean that companies are going to struggle to get these online sooner rather than later? And for companies like Microsoft, Amazon, Google, Meta, Apple, this is a hugely important piece of the puzzle for AI because they want the latest and greatest chips, and NVIDIA makes the latest and greatest chips. So ensuring that those get online and then helping to unlock some of the bottlenecks that they have with serving up to customers. Microsoft has said in the past that part of their issue with AI growth is they just don't have the capacity to hit all the customers that they want. So that's going to be, I think, the single biggest piece of this outside of did they beat and are they raising on guidance?
Dan, we had bulls come on the show, and sometimes they'll say, listen, actually just keep this real simple, right? They're bulled up on NVIDIA because they just say, listen, look at the hyperscalers, those big cloud giants you just mentioned. They're going to keep spending on AI. There's no let up in sight, they'll say, for maybe 12, 18 months. That's all good news for NVIDIA. Now, granted, we have skeptics too and say, fine, but that's all priced in at this point. But I'm just wondering how you think about that thesis going forward.
Yeah, look, NVIDIA is in the most enviable position out of any chip company. They make, like I said, they make the best AI accelerators. They started doing this a while ago, and they were pouring money into it. I think if you speak to Jensen, Wong, the CEO of NVIDIA, he'll say how people thought it was a weird choice and that they shouldn't. Now it's paying, insane dividends for them. But there are competitors in the space. Obviously, AMD is catching up. I think that the issue there is there's some software lock-in with NVIDIA that they're able to do with their CUDA software. So if you're already in NVIDIA and you've been using their chips, it's basically what they try to do with Blackwell is you can just take out the prior generation Hopper chip and drop a Blackwell chip in, and boom, that's it. There's still obviously a bunch of companies that are building out huge servers. These are water-cooled, some of the Blackwell units. So that's another piece of infrastructure that companies have to basically take into account. And just to, give it a sense of what water cooling is, it literally is liquid running through tubes and kind of a massive radiator to cool off these chips, because air cooling, where you use fans, just isn't enough to keep them cool because they're running at such high temperatures because they're so powerful. And so, Intel is trying to make its way in the space. Obviously, it's not doing as well as they would hope, but then their hyperscaler customers, NVIDIA's hyperscaler customers, are also trying to build out their chips. So yeah, NVIDIA is still riding high. They are still the best there is at this, but we've pointed out before, there is competition waiting in the wings and just trying to build up on its own.
Yeah, the question is, I guess, the timeline for all of that, Dan.
Right.
So looking forward to what we hear on all of these fronts today. Appreciate it. Thank you. Well, stocks broadly are lower ahead of those NVIDIA numbers, which could definitely set the direction of markets for some time to come. For more on what we can expect moving forward, let's welcome in Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist. Scott, it's good to see you. So as we await NVIDIA here, we've seen the momentum in the market kind of stall out as of late. So where do you think we go from here, and how much does it depend on that report that we're getting after the close?
Well, Julie, I think over the next couple of days, this NVIDIA report, that's going to definitely play into what the market's going to do. But I think, at some point, we think the market's probably going to broaden out. You're probably in for a few quarters here of economic slowdown. And so I think the big growth companies that have been driving the market, like NVIDIA, they're going to continue to do well because they're less susceptible to just the ebb and flow of the economy. I mean, this AI spend is going to keep going. Very few companies are really making money off it, but a few companies are, like NVIDIA. And so I think what we're hoping for, to be honest with you, is after this gigantic run-up we've had over the last 12 months, let's call it 40%, you want to see some pullbacks in here because people are generally, at least our clients, they tend to be underinvested. They have cash they want to put in the stock market, but they're hesitant to chase it here, and I think that's probably a good idea to be a little cautious in here. And hopefully over the next couple of months, we'll see some pullbacks. Probably just, is inflation going to go up or down? What the Fed's going to do, that might trigger a little bit of a sell-off. So we're hoping to see some downside here because I think, financials, industrials, communication services, energy here, as long as oil's not much lower than where it is now, we want to broaden our exposure out. You don't want to have all your eggs in one basket. And I think it's going to be better the second half of next year, but hopefully we'll get some opportunities to buy some other sectors.
Scott, I'm curious, we are so laser focused on Nvidia here, right? Traders, investors, what they report, what they guide, what does CEO Jensen Wong say on the call, right? Everybody's so glued to it. I'm just wondering, does that suggest anything to you more broadly about the market, Scott? Is that a source of concern or wariness for you, a certain, fragility about the market?
Well, I still think that, a broader market, when you're coming into a top and it's very narrow, that's usually takes you to the ultimate top. Now, that's not saying, we're there because we think we're going to be at 6,600 by the end of next year. But a broader market is always better. I think it's likely that some of these big growth companies, you see their earnings growth slow to some extent, not a lot, but to some extent, and you see the rest of the market in next year, maybe broadening out their earnings. So it might be a little more evenly dispersed instead of just a handful of stocks driving the market higher and basically accounting for most of the earnings. So broader is better. It's pretty narrow right now, and I think these growth companies are going to continue to be the ones that drive the market. It's not, it's not time to be overweight small caps or overweight high yield or any early cycle type thing. We're still late cycle here in the markets, and the economy's going to slow down a little bit, I think, Josh.
So interesting that you say not the time to get into small caps, because it feels like everybody likes small caps here, Scott, and they've liked them a lot this year, and it hasn't really paid off. Why do you think specifically there it's not yet time?
Well, Julie, it was really for, I guess, a couple of years there. It was great to be, overweight the S&P 500, underweight the Russell 2000, and that worked really well. But small cap stocks, they tend to be, when you're coming out of a slowdown, when you're coming out of a recession, that tends to be where people will put money to. They're riskier stocks. They have fewer products. Their balance sheets aren't as good. Their cash flows aren't as good. But that's where you see the earnings growth when you're coming out of that slowdown. Now, we certainly don't think we're going to see a recession, and I think you might be able to make the argument that whenever we're through this next slowdown, let's say toward the middle of next year, the jump higher in small caps, it might not be the same magnitude that you would see in other cycles, because once again, there's still going to be a situation where these big companies that have the products that are, knocking the cover off the ball, that's where people are going to want to be. So I don't think the market's going to broaden out how it typically would when you come out of a slowdown. But we do expect some other sectors to be at least participating in this once we get into the middle of next year.
And speaking of those sectors, Scott, it looks like energy is your most favored here. That's your number one. How come energy?
Well, I think because if anytime oil is down at 70 or a little bit below, we just don't think it's going to go much lower than that. And even though, Josh, I said that we think the economy is going to slow here, and that's, let's face it, that's why oil has been down here in the 60s. But if we're correct and we see some better economic growth, let's say we get out of next year with a 2.5% GDP, we see some better growth in Europe, we see some better growth in China and the rest of the emerging world. There's still a shortage of oil when the world is humming, and that's certainly not the case now, but we expect it to be picking up speed, and the demand for oil, we think, is likely to drive prices and the energy sector higher as we move through into the second half of 2025.
Scott, just to make sure, you mentioned 6,600, I believe, for year end next year.
Yes.
Is your target. But it was 6,300 quite recently. No?
It was.
So what?
It was, Julie.
Yeah. What took it up?
Well, I tell you, I think for us, and this has been a little bit of a tricky year for us because the economy's been better than what we expected. Earnings growth has been better than what we expected, and I think that's we think inflation's probably going to be a little bit higher at the end of next year than where it is now, but it's still not going to be at dreadful levels. So the Fed's going to cut a little bit more. Earnings are going to set another record next year. The economy is going to be better than what we thought. And so really that's what kind of pushed us to raise our target a little bit and be a little bit more optimistic about next year.
Gotcha. Scott, good to see you. Thanks for your time.
All right. Thanks, guys.
Take care. We're just getting started here on market domination. Coming up, Target shares sinking today after miss on the latest earnings. We're going to speak to an analyst on the other side about what those results mean for Target and for the greater retail sector. And the wait is almost over. After the closing bell today, it's the latest earnings results from Nvidia. We'll get you the numbers and analyst reaction as soon as the numbers cross. In the meantime, stick around. Much more market domination still to come.
Software company Palantir has been riding the AI wave this year, surging about 260% year to date. Our next guest says, though, the multiple at which Palantir is now trading at is unsustainable. For more, let's welcome in Brent Till, Jefferies senior analyst. So, Brent, always good to see you. Let's get right into it. You got the equivalent of a sell now, Brent, on Palantir. How come? Walk us through the argument.
Well, the fundamentals are alive at Palantir. So this isn't a fundamental call, it's a valuation call. And if you look back at the history of software for the last 20 years, there's no software stock that's ever remotely even maintained a multiple at this level. We saw Snowflake get to 45 to 50 times, Datadog get to 30 times. And now Snowflake's 9 times forward, Datadog's low teens. So it's more of an issue around multiple. So we're not, we're big fans of the fundamentals and the value prop, what they do for commercial and government customers. It's the question of valuation. And so if you have to separate the two, the fundamentals, the company and the stock is in a completely different orbit that we've never seen. And honestly, everything has come back in. No one's ever sustained anything remotely close. And, I would say that Snowflake investors many years ago thought that it would sustain a 30 to 50 multiple, and look at how bad that stock has done. So again, Snowflake's a great company, but the multiple just couldn't survive the inevitable compression. And so let's assume we're wrong, and let's assume Palantir's growth continues to sustain at a 40% clip. It still would be one of the most expensive names even 4 or 5 years out. And so I think what's required here, for investors right now, it's been a great run. It keeps running up, and we're not discounting, hey, they've had easy comps. I mean, last year they can grow at the rate they're growing right now because the comps are easy. The comps are going to get harder. Ultimately, the expectations are harder, and the multiple has nowhere but to go but down. So again, kudos to them. It's great to see their market cap above Lockheed Martin. But again, we were talking about a company of $3.5–4 billion of revenue on a $135–140 billion market cap. It's just the numbers. That's what we do for a living. We take risk rewards.
Yeah, and you guys aren't the only ones that are sort of sounding this alarm, right? The street has gradually been coming around to this place where effectively you guys are all making the same case, which is this is too expensive given the outlook for the fundamentals of this company. And yet, to your point, it just keeps going up. What do you think is going on here? Why are people ignoring the valuation, still buying it?
There's a handful of reasons, right? If you look at this stock, it has a much higher individual retail component. So your uncle, your sister, like the mass market, owns it. So it's not just institutional owners. I spend my time talking to institutions, not individuals. Very few institutions own this stock because of what we're talking about. And so when I go into meetings with institutions, it's less than 1% of my time. They want to talk about Microsoft and ServiceNow and many of the other names that are in our coverage. And so it's been driven off of retail investors. And if you look at the last post one of their board members put out, talking about they're bringing it, on different indexes to get it put into different indices to get it into different indexes. They've done a great job and obviously driving the S&P owners up and having to own it. But again, that retail ownership has dropped. The institutional ownership has gone up a bit. And so I think the institutions are more sensitive than maybe, your uncle or your sister about valuation, because everyone in the retail market, hates the analysts and hates me because they're like, why are you sounding the alarm bell? And I'm not trying to sound the alarm bell on the company's fundamentals. I love the company's fundamentals. I love what they're doing. I believe in their value prop, and we're huge fans of what they're trying to do. But again, it's the valuation argument. So there's a lot of reasons why it's going higher, being put in the index, being in the hands of the retail investors, and their momentum has been really good. Their numbers have been really good. And so I think they deserve to go higher. Again, when you look at the revision of the multiple this year, it's multiple times. The multiples got revised up multiple times versus revenue growth has only gone up 9 or 10% higher than what everyone expected for the beginning of the year. So this is all multiple expansion. It's not actually even on the revenue numbers, right? So we look at it multiple ways, and it's just hard to justify that magnitude of move.
Brent, one more question. I know this is, you can't model this question, Brent, but I am interested in your thoughts about this. Is this company's strong connection to the incoming Trump administration, Brent? Alex Karp, the CEO, he was there in 2016 with the first Trump administration. His company was co-founded by Joe Lonsdale. I know Joe is at least informally in the mix there, helping friends in this second Trump administration. Is that a consideration at all for investors, Brent? Could that help, for example, spur more government work?
I mean, if you think about, when Musk and he's with the president and he's talking about creating this Doge community of government, efficiency, is the government going to be if the government's cutting headcount, are they putting money into physical things, or are they going to put money back into software and ways to make a leaner, smaller government more efficient? So I think the logical explanation would be they put more into software. We had dinner with Gary Cohn, the vice chairman of IBM, last week. And, Gary's view on federal government is many systems are about to fall over. I mean, they're so brittle and old, they need to be upgraded. And so Palantir benefits from that. Palantir's government business will play a central role if I'm right. And again, I think, not having talked to Musk about this, but if you get into a Tesla, and I own a Tesla, it's all software, right? He's a software guy. And he was tweeting about how government systems were brittle and need to be upgraded. So my bet would be in the next few years, government spend on software is an area that improves efficiency in a leaner environment in the government.
It still doesn't necessarily mean the stock is worth where it's trading right now. Brent, thank you. It's always good to talk to you.
Thanks for having me.
Let's turn to Target now. Those shares are plunging after the company reported weak results and warned on the holiday shopping season. Joining us now, Scott Mushkin, R5 Capital founder and CEO. Scott, it's good to see you here. Such a contrast with what we heard from Walmart, which seems to be gaining market share in what seem to be Target customers, right? Sort of higher income customers who are trading to Walmart. Why isn't Target retaining those customers?
Well, I think if you look at it, Walmart's done an excellent job. There's no doubt about it. Walmart Plus membership, getting it to your house very quickly. The other big advantage Walmart has is the produce, their fresh food business. And they've actually improved that business, the execution there a lot. And of course, Target has that, but it's not a destination for the fresh. So, Walmart's got some individual things. I never say congratulations to a company, but if you followed Walmart as long as I have, and we've been negative on Walmart before, it's been our number one pick for the last probably 2 or 3 years. But to see the transformation Walmart's done, and it's certainly on merchandising, it's the 3P business, offering different brands. With all that said, Julie, this is a Target problem. I know they blamed the economy and the sluggish consumer, and certainly certain categories that they are fairly big in are having issues like home, apparel to a degree. But if we look at our research and take a step back, and we do a tremendous amount of consulting, not just research, so we're in stores all the time. If you say what's R5's competitive advantage, it's our store on the ground research, and we've definitely seen execution at Target become much more inconsistent. And if you have that inconsistent execution at the stores, but you're really good at marketing, you're really good at branding, you're really good at the social media and the fashion, you're creating a pretty big disconnect between your business and what's going on in the physical stores and what's going on with the rest of the company. And we think that's a sizable issue for Target.
So let me ask you, Scott, if this is a Target problem, and on a day that the stock, I'm looking at we're down 21%. It's fair to ask, what about leadership at this company, Scott? Is CEO Brian Cornell the right man for this job? Does he have the right strategy in place?
I've known Brian for years and years, and I'm a big fan of Brian's. I would say, however, that their thinking about what's going on with their consumer scores and their execution at the stores really goes counter to what we're seeing out there. And we see this a lot with companies that we deal with. where the CEO is not necessarily getting a complete picture of what's going on with the company. Now, with that said, I mean, there's some good things going on with Target in our minds where, we talked about the brand, we talked about their social media. We have a social media score, monthly score that we put together. Target is always at the top of the list. Our consulting team thinks they've improved their fashion quite a bit over the last 2 years. And so there are good things there, but the store performance has got to improve. And I do think, to answer your question very directly, I do think that some eyes need to be open there regarding what's actually happening in the stores. Messy displays, dirty stores, out of stock. It's a problem. It's more inconsistent than it's across all the stores. But if you go in there and you've been enticed in there because of a Facebook post or TikTok, and you show up and the display is just piled with clothes and you can't find what you're going to, what you came there for, or you go to a display and they have all extra smalls and all extra large, so your size isn't there, or they're just out of stock. I mean, we saw them not set for Halloween 2 to 3 weeks before Halloween in New Jersey, in New Hampshire. That's a problem. You can't operate a company like Target with the branding you're doing and the expectations, expect more, and have stores that look like that. You just can't do it. And I think the traffic, grinding on here a little bit, but they had positive traffic in the quarter, which I think is, emblematic of how they are reaching out to consumers and resonating with consumers. So they have to fix this, and that's the bottom line.
Scott, it's funny. I did my own channel check, i.e. I went shopping at a Target over the weekend, and it wasn't messy, but it was chaotic. It felt like they had too much inventory. It was strange, and it wasn't well sort of organized. I was just doing a quick eyeballing of the stock since Cornell became CEO, which was just about 10 years ago. It's just about doubled, but that's half the performance of the S&P 500 and less than half the performance of a Walmart. Now, Walmart's had issues like you're describing before in its own stores, right? Where very inconsistent sort of how the stores look. How did it fix it, and how's Target going to fix that problem?
I mean, it's a great question. And when Walmart was running that way, we actually had to sell on Walmart this year, 5 or 6 years ago. But they threw a lot of money at labor. They kind of realized what was happening. And they said, we got to fix it. People that have known Walmart for a long time maybe remember when they came out and said, hey, we're going to spend an extra $1 billion on labor and get more labor in the stores. And that was just a down payment. They've done multiples of that. So it is it's always a labor problem, almost always. So a labor problem when you look at store execution, that's not really where it needs to be. The challenge with Target is they are actually growing their SG&A dollars and decently keeping up with kind of what's going on with expenses. So it seems to us, as we've looked at it, and if we were doing a consulting project, we'd have to look even more deeply. But it does seem like labor may be misallocated a little bit at the stores, that it's taking a lot of effort for them to run their e-commerce business, and that's taking some labor off the floor, which is leading to, as you say, chaos in some stores, not all stores. So they may have to put more labor, to the floor. We're also a little bit concerned around the culture at Target. Always been but when you go into a Walmart and people are busy neatening up the shelves and making sure the store looks good, which you more and more see at Walmart, and you go to a Target and the store's messy and you see the employees kind of BSing with each other, you start to wonder, do we have a little bit of a cultural realignment that needs to take place?
Yeah, investors certainly share those concerns today, Scott. Stock down about more than 21% right now. Thank you so much for your time, Scott. Appreciate it.
Thanks, guys.
Stick around. Much more market domination still to come.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst and most trafficked tickers of the session on Yahoo Finance's trending tickers page. First up, let's talk about Qualcomm. That stock is sliding today more than 6% after the company provided what some analysts found as underwhelming financial targets for its non-smartphone business at its first investor day in about 3 years on Tuesday. Qualcomm, which gets the majority of its revenue from both designing and licensing chips for smartphones, it's been expanding into semiconductors that go into other stuff, cars, personal computers, other devices. And I had the chance to talk to Qualcomm CEO Cristiano Amon yesterday, and this is what he told me about the company's AI outlook.
We see now AI running at the edge. It's much cheaper than running on the cloud, especially those models get significantly more capable. Those three combined with the rest of the IoT and auto business going to drive our diversification of Qualcomm to have, by the end of the decade, mobile is going to be 50% or less.
So this would be a big change for the company because most of the revenue right now does come from what they call the handset business, the smartphone business. But there's a threat to that business, a big threat, which is that Apple is talking about not buying its modems, its internal modems, communications, for its phones from Qualcomm, and it's going to make those itself. So Qualcomm, it's already been diversifying into these other businesses, but that's something that's, maybe lighting a little bit more of a fire underneath them. Looking at some of the analyst commentary, a lot of the analysts were positive on the day, but some are raising questions about how quickly, for example, it can ramp up its PC chip business. There's a lot of competition in that space.
They did highlight a huge TAM opportunity by 2030, at least as they say it. But to your point, Julie, I mean, the commentary I saw was broadly positive. Analysts talking about the product and technology roadmaps that they laid out, in their opinion, look strong. And even the handset business, I saw, analysts saying it's clear Qualcomm thinks they're going to still be able to grow even as they plan for Apple chipset sales to drop out. Yes,
definitely. They talked about mid-single-digit growth for that particular business. Just to quickly go over the actual targets, automotive revenues are going to be $8 billion by fiscal 2029. So these are 5-year targets. The Internet of Things, that business, it's going to be $14 billion. Now, what does IoT, as they call it, include? That includes PCs, it includes industrial uses, and includes sort of extended reality or virtual reality, whatever you want to call it, chips that go into that stuff as well.
All right, we'll keep watching.
Yep.
Our next trending ticker, E.l.f. Cosmetics. Shares, they are down in today's trade. That is following comments by short seller Carson Block, speaking at the Sohn conference in London. Block saying he's shorting the stock because he has concerns about E.l.f.'s revenue. So that was what made headlines here. They think the short seller saying, listen, they have overstated revenue in recent quarters, the buildup of inventory due to underwhelming sales, they said. Remember, they reported about $300 million in net sales for the quarter through September, adjusted net income of $45 million. Those both beat the street. Of course, Block, very well-known short seller. Bloomberg noting, by the way, Muddy Waters has built up at least 4 new short positions in the past 12 months.
Yes, and E.l.f. is one of them. In the report that accompanies the speech that Block gave, he talks about that imports from China have crashed, and that E.l.f.'s inventory, from that reason they're extrapolating, seems overstated by roughly 2 times. They go through a lot of data in this report. The stock does have at least one defender. That's Corinne Wolfmeyer over at Piper Sandler, who says that the inventory build is not a new development. It's something the company has talked about, but she says it remains to be seen what happens on the revenue front with the company. So we shall see.
All right, we'll keep tracking it.
Yes. The post-election surge in enthusiasm for crypto is now sending Bitcoin to another new record high. A new Trump administration fueling optimism on the future of cryptocurrencies. Galaxy Digital CEO Mike Novogratz, we talked to him earlier today on Catalysts about the potential innovation ahead for crypto.
Bitcoin's always been the gateway drug for the digital asset space. And with better regulation around market structure, around what's a security and what's a commodity, right? What's a utility token? Once we get more clarity around that, you're going to see a lot more development and innovation. So one of the reasons you haven't seen the great innovation in this space is people were scared of it, right? The big players were. And I think that's all going to change.
Here with more on where to direct that excitement surrounding crypto. We've got Bitwise Asset Management co-founder and CEO Hunter Horsley. Hunter, it's good to see you. You just heard Mike Novogratz talking there. There's also some new reporting today from Bloomberg that the White House is considering a sort of crypto czar as well, somebody to sort of spearhead all of the crypto plans that are being floated here. What do you think about what Mike was saying there in terms of what it might unlock? Like, what does that innovation look like for crypto in general?
Absolutely. I think Mike is spot on there. I think it can be hard for people to imagine because Bitcoin's been around for just about 16 years now. But this year marks the beginning of a new chapter, a more mature stage of the life of this asset class. And I think that the regulatory developments, the introduction of ETFs are components of that story. And I think that you're going to see a lot of innovation in new applications, but also the entrance of large corporates, which you've seen a few times this year with fintech companies entering the space, as well as large financial institutions. And then amongst our client base, family offices, wealth managers, banks, we serve over 4,000 wealth management teams and firms already today. And the trend is pretty clear that they think that it's a new story starting this year. And are engaging more with this asset class.
Hunter, what about this Bloomberg headline that dropped today? President-elect Trump's team holding discussions, Hunter, about whether to create a new White House post solely dedicated to crypto policies. So it sounds like some kind of potentially, Hunter, new kind of crypto czar there. What do you think of that idea?
I think it's fantastic. Look, there are over 100 million Coinbase accounts. There are tens of millions of Americans who own crypto. And the main request of investors, of institutions, of companies has been, we'd like clear regulation. And I think with the new administration, as well as the House and Senate, which saw over 300 lawmakers elected that are pro-constructive crypto regulation, I think there's a view now that it's time to implement that. And so steps like this, in terms of creating a role, as well as the ongoing dialogue with the space, firms like Bitwise and others, I think that's really promising, and I think it's all happening, and it's happening for real.
But Hunter, I guess what I grapple with is Bitcoin's at 94,000 right now. What's preventing anyone from investing in Bitcoin right now? What, from a policy perspective, what are the obstacles that are still in place?
Julie, that is such a great question. The answer is unfortunately in the weeds. It tends to be related to perhaps you have a broker relationship or a financial advisor relationship, and they've been constrained in allowing you to get access because of a rule like SAB 121, which is deep in the weeds of rulemaking and a result of a lack of clarity out of Congress. So there are a number of things like this. You've heard reference to Operation Choke Point 2.0, and I won't go into the weeds, but there's been this sort of behind the scenes limitation of how people can participate, institutions, individuals. And certainly, in the Bitwise Bitcoin ETF and our index fund, we've seen a ton of participation, but we also still hear from a lot of individuals, from wealth managers, that the systems they use or the accounts they use don't have access. And a lot of that has to do with the behind the scenes of the regulatory environment. So I think that will go from, possible in certain contexts to possible broadly with at least the guidance that we're seeing from the new administration.
Hunter, outside of Bitcoin, how do you know which assets in this space to be bullish on?
Josh, that is a $1 million question. One of the approaches that I think is popular at Bitwise, and we write commentary every week. We do analysis on a variety of things. But one approach that we see a lot more advisors taking is index solutions, where you say, I want to bet on the category. I think Bitcoin is the largest. I think Ethereum and Solana and Aptos and other things are interesting, but I'm not sure how it's all going to play out. And I didn't predict how the internet was going to play out. So I'd rather own the category. And Bitwise runs the Bitwise 10 Crypto Index Fund. It's the largest crypto index fund in the world. It allows an investor to do that. We have an ETF BITQ that allows them to own an index of companies. I think you're going to see more and more adoption of those index strategies because, exactly as you said, Josh, that question is always on investors' minds. but the answer is, I think, for many, going to be to invest in a portfolio rather than trying to correctly predict it.
Hunter, on the flip side, when one of these goes down, usually all of them go down. What are the contenders for the next catalyst that could cause a sell-off in crypto? What are the risks you're watching out for?
Yeah, that's so Bitwise has been around for 7 years now. I had less gray hair when we got going and chipped away at my soul a little bit. We've protected clients throughout that, and so definitely have had a firsthand seat at the different chapters. I think there's a few. The 2022 chapter was really a story of two things. Rates 10xing from 25 to 500 basis points, and that drew down ag, that drew down the Qs, it drew down almost every asset class, and crypto participated in that. So there's always the capital flow story that I think is interesting. But the real unique piece in 2022 was the counterparties. You had a lot of these crypto firms, some of them offshore, some of them run by less professional teams, most of them unable to operate within a regulatory perimeter. And it was just, it was like Lehman Brothers, Archegos combined. It's sort of in the crypto version. So that was really key to the story in 2022. I think that we're entering a new chapter in 2024 where you don't have as many of those crypto firms. You have a few leaders, Coinbase, Bitwise, Anchorage, others. But increasingly, the counterparties are Robinhood or Bank of New York Mellon or Interactive Brokers. And so I think there's a real growing up that came out of the crucible of 2022. I think that's less of a risk, though certainly always one we monitor with counterparties.
It's the topic in the asset class everybody wants to talk about, Hunter. Great to have you on the show. Appreciate it.
My pleasure.
Coming up, Comcast has confirmed plans to spin off most of its cable networks into a new publicly traded company. So is this good news for the cable industry? We're going to discuss when Market Domination returns.
Comcast has confirmed plans to spin off most of its cable networks into a new publicly traded company as it and others in the industry grapple with more consumers cutting the cord. The yet-to-be-named company will include USA Network, CNBC, MSNBC, Oxygen, E!, Sci-Fi, and the Golf Channel. Joining us now to discuss, Jessica Reif-Ehrlich, B of A Securities Senior Media Entertainment Analyst. Jessica, it's always great to see you and to tap into your expertise on this industry. Does this move make sense to you? And sort of what does it tell you about where we are in this industry?
It does make sense to split out the linear assets, or most of the linear assets, from the rest of NBCU. We had written a note this summer on Warner Brothers Discovery contemplating the same thing. And I think all of the traditional media companies are kind of thinking of what assets do they need to own to grow going forward, and what should they divest. So the cable networks are clearly in a very challenged universe. And I think this is the beginning of what could be an industry consolidation or an industry roll-up of cable networks.
Jessica, do you think CNBC and MSNBC can actually survive and thrive and, importantly, grow on their own?
I mean, those are very big brands that have multiple distribution platforms. But the trend is, it is what it is. The pay TV universe has been contracting. And so by kind of spinning them out, well, let's back up for a second. The person who's running the SpinCo, whatever it will be called, is Mark Lazarus, who is one of the most experienced and successful executives in the industry. Came from Turner. He's been at NBCU. He's chairman of the entire company, and he's bringing the CFO, who's also incredibly well regarded. So that alone says a lot, that they have incredible management at the top, and it won't be, they've said, not a lot of details, but that it will have, very low leverage. So it'll be well capitalized, likely to return capital to shareholders. So it's a business that can be run for cash, and it can be run more efficiently. So if it is in fact an industry roll-up, then you could take other companies, cable networks, and merge them in, cut out overhead, combine advertising sales, because you don't need multiple heads of sales and sales forces, and the same thing for distribution. So there are a lot of efficiencies to be had by combining many of these companies. Can these companies survive as part of a bigger entity? Yes, of course they can. And particularly, companies that have unique brands, and mostly what's going in from an NBCU standpoint are sports and news.
Right, and I mean, do they make more sense with another sort of pure content company? In other words, do you think once SpinCo happens, do you think or even before, do you think there's a chance it gets bought by another company?
Well, again, we think it's more of a roll-up vehicle. And so there are plenty of other cable network companies that could conceivably, be owned under this umbrella, could be bought, could be merged. It's just our point of view that there will be an industry roll-up over time. Eventually, could private equity come in and run for cash? Yes, it's possible. But these are incredibly qualified executives that are going with SpinCo. Do they have other plans? Would they buy something else? That's just unknown. Because look at the time frame. They say in the press release it will be roughly a year from now.
What about, Jessica, turning back to Comcast, what other, would you expect more deals, more moves with the assets they have left?
Well, it definitely, it should be accretive to both their revenue growth rate and their EBITDA growth. Because these are, again, cable networks are facing secular headwinds. For the Comcast, what's left, maybe it frees them up to do to make other acquisitions, possibly to grow bigger in cable, or we'll see. But the answer is it's possibly it could open the door for other things.
And Jessica, something we've been talking about ever since the election was, are we going to see the reignition of M&A across a number of different industries, but in particular within media? So I'm just curious where else you're looking right now. And if, for example, if SpinCo is going to be, or if it is going to roll up other companies, what could it roll up, or what kind of different combos are you watching for?
Well, there are challenged assets and there are growth assets. And so, look, we don't know what the new administration will bring, but given the Republican sweep, it seems more likely that there will be a kind of a pro-business, maybe a more looser regulatory environment to do M&A finally. And a lot of these companies, Warner Brothers Discovery said on their earnings call that it kind of opens the door. So many of these companies really need to kind of sift through the assets, sell some assets, and possibly, buy or merge with others. So it could be a very interesting couple of years.
It sure could. Jessica, thank you so much for joining the show today. Appreciate your insight. Coming up, it's almost time for the latest earnings results from Nvidia. Got you covered with all the action following the closing bell, including those numbers as well as analyst reactions. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's see where the major averages ended the day. In the green, surprisingly, is the answer for the Dow, which just sort of had a late day surge as we await Nvidia numbers. Perhaps that one of the reasons. The Dow up about 0.25%, 139 points here into the close. The S&P 500, it looks like might end in the green, but really it's going to be a photo finish here as the numbers settle out. Looks like it could be. And the Nasdaq also coming up off the lows of the session, but not quite finishing in the green, up about a tenth, or down about 0.1%, excuse me. But indeed, we are awaiting those numbers from Nvidia, so that's going to be the real catalyst going from here. Markets kind of treading water to some extent as they await the main event. Jared, what do you got?
Yeah, a little bit of drift here. In these instances, I sometimes go to the VIX to see what's going on. Indeed, we had a little bit of fear priced into the market here. You can see the VIX up to 17. I'll show you the last 10 days, basically since the election. It's been 11, but we have been steadily heading just a little bit higher, zigzagging over the last few days. So a little bit of a trend that we will keep in mind. And when it comes to the bond market, 10-year T-note yield is up 3 basis points today, 4.41%, pretty close to the recent highs. We can see that level over there, almost to 4.5%. And finally, the US dollar index elevated as well. But let's check out some sector action in our heat maps. And we can see healthcare took the first position today. That was up 1.19%. Energy also up more than 1%. What didn't work, staples to the downside, consumer discretionary, which has been a leader since the election. Also financials, another leader since the election, took a little bit of a back seat today. And if we take a look at our leaders, guess what? Bitcoin, GBTC, that's my ETF proxy, that is up 2%. That is in the leadership position. Also, China did pretty well. KWEB up 1.76%. Solar energy, biotech, oil, small oil, I should say, home builders, and then another biotech ETF, and then software. That rounds out the top row there. And let's just leave it on ARC. A little bit of a red day there for a lot of these components. Not all, but Tesla down 1.15%. Josh?
Thank you, Jared. Investors on edge as Wall Street waits on Nvidia's third quarter earnings report. Joining us now is David Sekera, Morningstar Chief U.S. Market Strategist. David, just to start a bit more broadly, we had that nice move off the Trump win. You say, though, David, that short-term gains here could be limited. How come?
Exactly. In our view, we think valuations are getting to be, just too high at this point. So I think there's limited price action until earnings over the next couple quarters start really catching up to where we are on a valuation basis. In fact, right now, when I look at the U.S. stock market, I think it's really already priced to perfection. When I look at what's being priced in today, even before the election, the market was already pricing in just the ongoing economic strength we saw both in the second and the third quarter, looking for ongoing strength in earnings. Everyone's pricing in long-term monetary policy easing, moderating inflation. And while we did have this backup in interest rates since the Fed started easing, I think most people are still looking for long-term interest rates to subside, next year. And of course, now here after the election, everyone's pricing in the extension of the tax cuts and the Jobs Act. Everyone's pricing in a higher probability of additional tax cuts, both at the corporate level and the personal tax rate level. And of course, looking for looser regulations, lower antitrust activity. We're looking for a pickup in M&A next year, especially in the tech space. So as far as I can tell, based on our valuations, it's all priced in at this point.
So does that mean, David, then the market is vulnerable for more of a sell-off? And if it is, what are your potential catalysts you're looking for that sell-off?
For the next couple months, I'm not looking for a sell-off. I think the tailwinds still outweigh the headwinds that we're seeing at this point in time. So it's really not until early next year, once the Trump administration comes in, it really starts to tell us what exactly they're planning on doing. And to me, it's always a difference in what they plan on doing or what they talk about on the campaign trail versus what they try to implement. So that to me is really going to be the next bout of volatility that we probably see in next year in spring.
So overall, valuation doesn't look too attractive to you, David, but under the hood by sector, in your opinion, what do I want to be overweight here?
There's a couple of different areas to overweight. We still think communications is the most undervalued sector. It trades at about a 12% discount to our fair value. And of course, you can't talk communications without talking Alphabet. That stock has had a lot of overhang there with the Department of Justice, antitrust litigation going on there. We think that's really being overdone in the marketplace today. At the end of the day, we just don't see a breakup in the cards. So we think that's a very undervalued stock. Trades at about a 20% discount to fair value, puts it in our fair value in our 4-star stock rating category. But we also like a lot of the more traditional communication names as well. Verizon's another one that we think is still undervalued. A couple other areas that I like are going to be energy. Energy is trading at a 4% discount to fair value. A number of the energy stocks there, the E&P companies we think trade at pretty good discounts. Devon's a 4-star stock at a 20% discount. And Exxon is a 3-star rated stock, but still at a 12% discount. And lastly, I'll point out healthcare. So the sector overall is at a 5% discount, but really it's actually even a lot cheaper than that on an individual stock basis. Big reason for that is Eli Lilly. It's a 2-star rated stock, trades at a 25% premium over our fair value estimates. Yeah, I don't think the market's really contemplating the long-term growth pattern there is really going to start to halt in the next couple of years. Yeah, we're looking for 16 new weight loss drugs to be launched by 2029. So I think that's going to put a lot of overhead pressure on that stock in the next couple of years. But a lot of other stocks, especially like the device makers, we think are significantly undervalued. Zimmer Biomet is probably one of the better calls there. It's a 4-star rated stock at a 25% discount.
And how about Nvidia, David, which of course we're awaiting. And I'm curious not just for your take on Nvidia itself, but we have been talking so much about its influence over the rest of the market. I know there's some analysis out there that's saying that this is the event from now until the end of the year, even accounting for the Fed. What do you think?
Well, we do have PCE coming out, soon, so I think the market will concentrate on that. And depending on where that comes out, they could, bring a lot of volatility, just whether or not people start to price in maybe the Fed not easing as much as what's currently in the market. But yeah, Nvidia at this point, it's a 2-star rated stock. It's now trading at a 40% premium to our $105 fair value. Now, in the short term, we still expect another strong quarter. I certainly expect the results will beat their guidance. I know our analyst thinks that they've sold out of their Blackwell products for at least, the next 12 months. Still, with the supply constraints out there, they're able to sell everything that they can build. People will pay whatever price they're going to charge. Yet, I think that and everything else is already priced into that stock. Not only are they going to need to beat and raise, but they're going to have to raise above any of the whispered numbers out there just to hold, the current value of where that stock is trading. You always got to remember, the value of the stock isn't necessarily just about this quarter earnings or even, next year's earnings, but what it's going to do over the long term. I pulled up our model and I looked at our assumptions here. So we're looking at revenue in 2025 of $128 billion. We're projecting that to go to $240 billion by 2029. We're looking for operating margins to stay at their historical highs over that entire forecast period. So earnings of this year, $283 going up to $514 by 2029. Essentially, not only are you paying 37 times fiscal year 2026 earnings, but that's still 28 times our earnings estimate for 2029. So a fully valued stock, if not significantly overvalued in our mind.
Let me ask you, David, so how important is this print? When you're talking to your clients, you look at the print after close, how important is potentially NVIDIA's print to just the overall direction of market, at least in the short term here?
Well, in the short term, of course, it'll have a huge impact not only on its own stock, but all the other stocks that are leveraged to AI, and even those like second derivative stocks that are leveraged to AI. There's a lot of stocks this year that have been pulled up with kind of the AI. I don't want to use the word bubble. It's not necessarily the .com period yet, but there's a lot of tech stocks that have been pulled up with everyone looking for the next AI play. Stocks like IBM and Oracle, we think are much more legacy technology companies that, yes, they will have some benefit from AI over the next couple of years, but we just don't see that amount of benefit for those two companies really outweighing the pressure that they see in the rest of their business. Those are both two stocks we think they've run too far, too fast this year. I believe they're both rated 1-star and trade at very large premiums to our fair value.
David, thank you so much for your time today. Appreciate it.
Oh, thank you.
All right, also just crossing the wire is Palo Alto Networks with their first quarter results. The stock right now down nearly 6%. Let's get you those numbers. First quarter adjusted EPS 156. That's a beat. The street was at 148. The first quarter revenue, Julie, $2.1 billion. The street was closer to $2.12 billion. Looking ahead to the full year, and maybe this is where the pressure could be, RPOs, Julie. I'm saying $15.2 billion. The street was closer to 15.3 as well. I'm just looking over some other. They gave second quarter adjusted EPS 154 to 156. The street was at 155. But maybe it is that full year RPOs that has at least people maybe a little cautious here, at least initially in the after hours.
Yeah, the other headline I'm seeing from the release here is the company is doing a stock split, a 2-for-1 forward split. And it looks like that it will be effective after the close on December 12th. So it'll begin trading on a split adjusted basis as of December 13th. December 16th is when it's going to be trading on that split adjusted basis. Now, Nikesh Arora, the CEO of the company, saying our first quarter results reinforced our conviction in our differentiated platformization strategy. Now, this has been sort of the buzzword within cybersecurity, this sort of one platform. that these companies are moving to, but the transition to that platform for some of them has been a little bit challenging, depending on which player that you're talking about.
Yeah, you look at this name, I mean, not just for Palo Alto, but you look at it as kind of like what it tells you about the broader security software space, the general IT spending environment. I mean, that is going to be a big topic on the call, the platformization, which really means just like unlocking customers for the long term with kind of different bundling initiatives. That's been a big focus, both financially and strategically. A lot of fans on the street, by the way, on this name, including our friend Dan Ives over at Wedbush. You know, I know it's one of Dan's favorite cybersecurity names to own, at least kind of over the next 12 to 18 months, in part because of this emphasis Nikesh Arora has on platformization, but certainly it's initially here, disappointment in the after hours.
Yeah, let's take a look at Snowflake as well, software company here, and those shares going in the opposite direction, up more than 14% here. It looks like a lot of that has to do with the company's fourth quarter product revenue forecast, coming in at $906 to $911 million. Analysts had been predicting just about $891 million. The third quarter numbers also coming in ahead of estimates. Earnings per share, 20 cents. That's 5 cents above estimates. Revenue, $942.1 million is also ahead of estimates here. So all of those beats driving the shares higher. And the company's also buying a company called Datavolo. That's one of the things that it's saying in its releases today. We're seeing some of the other kind of competitors to Datavolo, I guess, on the rise, and also companies that compete with Snowflake here. So, different stories for these different companies.
Yeah, I mean, sentiment on that name had been also just so negative. Julie, I mean, heading into the print, it was like down 35% year to date. Growth concerns had been kind of front and center leadership changes, competition, but nice move, at least initially here. All right, joining us now to discuss Palo Alto earnings is Matt Hedberg, Managing Director and Head of Global TMT Research, RBC Capital Markets. Matt, it's great to see you. So Palo Alto reports, at least initially after hours, investors seem disappointed, Matt, but give me your reaction, your response.
Yeah, thanks for having me on. Some of it's going to depend on what they say on the conference call. There was a lot of enthusiasm from investors into the print, and so I think some of that could be weighing on the stock here. A lot of it often depends on what Nikesh says on the call in terms of sort of the outlook and the view going forward, especially as we come out post the U.S. election. And so yeah, I mean, at first blush it looks pretty much down the middle. I'd say guidance looks a little bit better. But yeah, I think a lot of it's going to depend on the commentary. I had two companies report tonight. Snowflake was the other one. Sentiment was very negative on Snowflake into the print. That's up pretty significantly in after hours. And so some of this could be just positioning. But yeah, it looks like the Palo Alto numbers itself look pretty solid to me at first blush.
Matt, I'm also curious about this decision to do a stock split. Now, the shares are up this year, but they're up, about 30%. Over the past 5 years, they've been kind of a monster here. So does that stock split, do you think that's a good move for them?
I mean, stock splits are, a little bit more academic.
Right.
I mean, I think, so I don't know that it has a huge impact on how we think about the company. But yeah, I mean, I think, ultimately, we've liked the stock. We like what they're doing from a next gen perspective, especially as we think of where the cyber industry is going. We just came off of a 2-day TIMT conference here in New York. We had a lot of cyber companies talking. And I think especially as we get into more of an AI centric world, we think Palo Alto is in a really strong position to help organizations deal with increasing cyber threat that is oftentimes AI infused.
This strategy, Matt, that they have of platformization, explain that to our audience, Matt, and what that could mean for the company going forward, financially and strategically.
Yeah, listen, we like the strategy. I mean, candidly, it's a fancy way of saying bundling. Palo Alto has a broad platform of offerings. And when we think about what they're trying to do is they're trying to disrupt a lot of markets here, whether it's the firewall space, whether it's cloud cybersecurity from a cloud perspective. And so we see the company's got a large balance sheet. They're able to leverage that from a deal financing perspective. And so we do think the platformization strategy, although met with initial skepticism, ultimately has proved to be a successful mechanism for them. But it's effectively a way to consolidate share in what is a very fragmented market. We increasingly believe some of these larger platform vendors are in a strong position to consolidate what is an extremely fragmented cybersecurity market. So yeah, we generally like the strategy. We'll have to hear how Nikesh is talking about it tonight in a little bit here, but we've generally liked the strategy.
And Matt, I want to switch gears and ask you about Snowflake, which I know is the other one that you were looking forward to.
Yeah.
As Josh mentioned earlier, the stock was falling into these numbers and now is seeing a pretty good bounce here. But it does seem like, at first blush, that the numbers justify it. Do you think so?
Yeah, I mean, again, like we'll have to see, what the management team says here. But you're 100% right, Josh. There was a lot of negative sentiment from an institutional investor perspective on Snowflake into the print. Listen, there's a lot of questions about the competitive landscape here, how Snowflake fits into the broader analytic landscape. And when we've seen this broader software rally, the IGV is up pretty substantially over the last month. Snowflake really hasn't participated in that. So I think some of this could be a little bit of a relief rally. There could be a little bit of short covering. But we've had a positive stance on the positioning. We think it's a big market. We think there's room for multiple large players in this growing data analytics market. And so, yeah, I think some of it is just more or less positioning, at least at first blush. But a lot of it will be dependent upon how the management team talks about the future.
What about Matt, Snowflake's new CEO? I mean, so relatively new on the job, stepping into some big, high-profile shoes there. What do you make the job he's doing so far?
Yeah, listen, we thought they needed more of a product focus. We thought they had a great sales organization, and I think bringing in a CEO with that is certainly more product oriented, I think is the right move. I think at this point, they're trying to play catch up to some competitors in certain areas here, and so I think it's the right place at the right time for this. I think the question will now be, can the sales force sell some of these newer products like Snowpark, like Cortex? The race is for a lot of this AI developers and how they think about analytics, and so we think the change there was the right move. I think the jury is still out on how successful some of this product innovation will be, but it's certainly infused, we think, a lot of innovation in the company, and ultimately we think that pays dividends longer term.
Matt, always great to see you and have you on the show. Thanks for joining us.
Appreciate the time. Thanks, guys.
And coming up, it's the moment we have all been waiting for, the latest earnings results from Nvidia. Stay tuned. We're going to get you the numbers and analyst reaction when market domination overtime returns.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Nvidia's third quarter results just out here hitting the wire, and the company beating estimates. Not a surprise here. Third quarter data center revenue at $30.8 billion, above the $29.1 billion that analysts had been anticipating. Overall revenue, $35.1 billion, 33.25 is what analysts have been looking for. Gaming revenue at $3.3 billion, a little bit better than estimated. That was a kind of volatile area in recent quarters. Adjusted earnings per share in the third quarter, 81 cents versus the 74 cents that analysts had been anticipating, and gross margin coming in at 75 cents, in line with estimates here. The company's forecast for fourth quarter revenue seen at $35.5 billion, plus or minus 2%. The estimate was for $37.1 billion here. And we see the shares falling in the wake of this. Now, there were a lot of questions about whether, there was not really a question of whether or not the company would beat. Everybody seemed convinced that NVIDIA was going to come out and beat estimates. But the question is, what were people actually expecting versus the sort of consensus? What, by how much would they need to beat? And it seems like also that the fourth quarter revenue forecast is not a blowout, but that's what we've seen as of late. So not a shock here that we are seeing the stock fall to some extent. We've got some commentary from Jensen Wong, the CEO, that is coming in the statement too, Josh. He talks about the age of AI being in full swing, that networking demand is strong and growing, and he says Blackwell production shipments will begin in the fourth quarter of this fiscal year.
Yeah, and so initially data, of course, as always, Rob, expectations also, Julie, running into this print were red hot. It was up about 190% year to date. I do think those comments, though, about Blackwell, that to me is going to be the core issue. What do they say about Blackwell? Not only this release, but it'll be the focus point of the call with Jensen Wong. The tone he uses, what does he see ahead? Because I think that's just sort of core here to whether you think the growth story can continue for this company.
Yes, most definitely. Now, again, just to be clear about what I'm saying about the calendar here, they're currently in their fiscal fourth quarter of 2025. So they're saying Blackwell chips are going to begin in this quarter here. So then they said they're going to be shipping both Hopper and Blackwell in this fourth quarter. There's been a lot of talk in recent quarters. Were they going to see a pullback in orders of Hopper, their last chip, as clients were anticipating an allocation of Blackwell that was expected to have an effect last quarter? It didn't seem to, so we'll be waiting for more commentary on that. He is saying that Hopper and Blackwell systems do have some supply constraints, which is not a shock. That's something that's been sort of percolating and talked about.
By the way,
in the
as these comments are coming out, you've basically battled right back to the flat line. I mean, we dipped about 6% in the comments coming, so we're kind of still shaking out here. Full comments from Jensen Wong are, the age of AI is in full steam, propelling a global shift to NVIDIA computing. He goes on to say demand for Hopper and anticipation for Blackwell in full production are incredible, in his words, as foundation model makers scale pre-training, post-training, and inference. And you see now we're down just about less than 1%.
Yeah, and there's probably going to be more volatility as well once we start the call, and once he takes some questions about what is going on from here. We've also been talking about, at some point, is there going to be more competition here, either from companies that are making their own chips in-house or contracting out that manufacturing for custom chips. And so that's been the talk really ever since early last year, when we really started to see NVIDIA's numbers explode upward. Was there going to be competition? What was it going to look like?
Yeah, the problem is, for the competitors, Julie, you look what Jensen Wong has really built there. We've had analysts come on and of course run through this, but he's built out the software, he's built out the hardware, he's built out the networking. It is this platform that is just very difficult to compete with. I do think one interesting question, we're going to get analyst commentary, is, listen, you've had the big cloud giants spend. And even bulls they'll say, listen, even 12 months out or 18 months out, it's going to continue. One question is what does happen after that? Who picks up the demand then? Is it applications, is it industrial AI? But we have some very smart people to ask that very question.
We do.
All right, CFRA Research Senior Equity Analyst Angelo Zeno joins us now with more in NVIDIA's quarter. And Angelo, it's great to see you. Listen, so NVIDIA reports, unsurprisingly, we're bouncing all around here in the after hours, but give us your immediate reaction, response to the print, Angelo.
Yeah, thanks for having me. So as far as the quarter was concerned, looked great. I think we were looking at 33 billion going into the print. So, I think the company guided, a couple of months ago at 32.5 billion. So, the numbers were incrementally going up kind of into the print here. And then they kind of posted a number that was, about 2 billion or so above what the expectations was. Clearly the guidance, I would say, is it was above what we expected. We were looking for 37 billion, but you've kind of got this game now where, you kind of have to beat the street by at least 1.5 billion to 2 billion. You didn't get that as far as the guidance is concerned. I personally would not be worried about that. What we've told investors out there is we expected Nvidia to kind of be a little bit more on the conservative side of things as far as the guidance was concerned for the January quarter, just because this Blackwell launch is kind of the shift towards this platform-based offering, and it's a very complex chip to make, and I think you have to kind of err on the side of caution here if you are kind of that management team, and if you over-deliver in come February. So I think this is the right move in terms of the guidance. I don't think you should read too much into it. I think all in all, this is these are pretty good, strong results.
And Angelo, the CFO commentary came out as well, and they say in there both Hopper and Blackwell systems have certain supply constraints that we know, and demand for Blackwell expected to exceed supply for several quarters in fiscal 2026. So does that sort of match what the market has been expecting? How do you, it sounds like you think that NVIDIA's sort of managed expectations pretty well.
Yeah, listen, we had actually written, I think, in our preview on Monday that we expected Blackwell delays to persist through the end of calendar 2025. So that kind of goes in line with, I think, the commentary that Jensen had made. He had made, comments just several weeks ago about kind of the insane demand that they're seeing for Blackwell. So we know the demand is strong. We know the demand is there. We know the revenue is going to be there. So again, it's one of those things as far as the guidance for this quarter is concerned, probably has more to do with some of the supply constraints and them kind of being a little bit cautious on the launch side of things. But yeah, as we kind of start seeing this ramp in the April and July quarters, and we believe a nice step up in terms of the revenue trajectory there, given that this is again kind of this platform-based offering out there, these rack solutions, then you're going to see kind of significant improvement in fundamentals. But yeah, the supply constraints will persist. It'll probably hinder them from kind of selling what they want to sell, let's say over the next 6 to 9 months. But still, I think it also provides some very good visibility out there for investors looking out over the next 12 plus months.
Angelo, we know, listen, the big cloud giants have been spending. That's great news for NVIDIA. Do you see that simply just continuing at pace, Angelo, for, is it 12 months out? Is it 18 months out? What do you estimate?
So, I think what we've said is, we believe we're going to see sustained demand. So, and I think that is kind of the key question out there is how sustainable is the spend out there from these hyperscalers. I think I quickly saw in the release, I think about half of data center demand this quarter came from your cloud service providers, your hyperscalers out there. So, it's a big number out there. These hyperscalers making them a huge chunk of their data center revenue. And, when we kind of think about, going into 2025, again, we're looking for the growth rate to decelerate. But high teens growth, let's call it, 15 to 20% growth out there is still a very, very good growth rate out there. And when you look at the share gain potential that NVIDIA has within kind of their wallet share gain potential on the data center side of things, we think they can grow at least 2 to 3x what that growth number is in terms of the data CapEx growth number is, and potentially even more than that. So at this point in time, when you kind of look at the spending levels, we think it is sustainable, which is what is key through 25, and I think more importantly into 2026.
And just to put some numbers on what we've been talking about here, revenue was up 94% year over year to that $35 billion number we've been talking about. Data center revenue specifically was up 112% year over year. Angelo, as you look at the stock reaction today, pulling back a little bit, if you're an investor in the market and you're trying to figure out whether you want to get in here, is there any reason not to buy Nvidia right now, especially as you see it pulling back?
Yeah, listen, I think as far as Nvidia is concerned, I mean, if you told me what I thought would happen to the stock, my initial reaction would have been it probably would have pulled back just because of the run we've seen into the numbers here. Now, when you kind of think about, the expectations or the outlook over the next 12 months, we continue to see upside to where those expectations are. But more importantly, are there risks out there that could potentially, cause this stock to potentially underperform over the next 9 to 12 months? I think there are definitely risks out there. I mean, we're kind of, entering kind of a new administration here going into 2025. I think what happens from a tariff perspective, how, trade kind of looks in terms of, what happens, what does the Trump administration do with kind of, on the semi side of things, and more importantly, these leading edge technologies, I think is going to be extremely important to kind of keep an eye out for. What happens with Taiwan over the next couple of years, also, something to kind of keep an eye on. But, if you're an investor out there and you're kind of looking to get into the name, the fundamentals of this company, the free cash flow potential of this company, we think will continue to be absolutely enormous and exceed some of those expectations out there. And as a result, I mean, we continue to have our buy recommendation and do recommend investors to buy on those pullbacks.
Angelo, thank you so much. We're still sifting through all these numbers. We'll be listening to that conference call very closely. Really appreciate your instant analysis.
All right, thanks for having me.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There was a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Nvidia earnings beating analysts' expectations on the top and bottom lines, but the revenue raising some concerns for investors, which was mostly in line with Wall Street estimates. One analyst just telling us it's not a worry for him, but the stock is lower on the news. We've got a closer look at those results straight ahead. And Nvidia's results wraps up third quarter earnings season for the Magnificent Seven. We've got the report card and what investors should be thinking about heading into the new year. Plus, even after Nvidia's results, there are plenty of market moving events to keep an eye on for tomorrow. What you need to know to get ahead start for Thursday. Well, Nvidia, the last name of the Magnificent Seven stocks to report results, reports a beat for the third quarter as Wall Street digests earnings from the chip giant, and Yahoo Finance's Josh Schafer has the top takeaways from the Magnificent Seven stocks this earnings season. Josh.
Yeah, Josh, so we're going to take a look at how the Magnificent Seven performed this quarter and also include Nvidia, which just reported, of course, in that. One of the key takeaways, Josh, from this quarter for me was earnings growth has not been the problem for these stocks. Nvidia just beat on earnings estimates. That checks the boxes for all of the Magnificent Seven, having earnings coming in better than Wall Street had expected. That was largely expected, right? That's kind of been the trend here. Where the issue has sort of come in from a different perspective when you look at the stocks, Josh, has just been what stocks had rallied into the print. What stocks are proving how they're spending AI, right? So I'm looking at a 1 month here. So this kind of encapsulates some of the earnings move and a little bit of the Trump trade. I'm looking at you, Tesla. Not all of that was off earnings, right? But overall, when you look at the companies that rallied, look at maybe an Alphabet, the stock hadn't done that well going into the print. If I zoomed out a little bit further, it hadn't been a name that had been rallying through the fall, right? Then it gets a pop off of earnings. Okay, I can see how that plays out. You take a look at Meta. The bar was a little bit higher, quite candidly, right? Coming into earnings here, had this big move higher. Meta reports earnings and revenue that beat, but they're saying they're spending on AI and the market just doesn't quite love it. I think to some extent, you could argue you're seeing a little bit of a similar thing with Nvidia, right? Remember, when we zoom out on this chart, Josh, look over a year-to-date period.
195%.
Up almost 200%, right? So for it to be off 2% after hours right now, okay.
Right,
maybe,
red hot into that
maybe
print.
things are okay, right? And it's just not necessarily bringing in new buyers. But the one thing I wanted to point out specifically with what investors have been focused on, this is a chart from Goldman Sachs, it's all about the spend.
Yeah.
Look at how much these hyperscalers have been spending in CapEx, right? This also includes Oracle, I should know. We're talking about Mag 7. They grouped Oracle in here as a hyperscaler, so it's not all Mag 7. But that's been the question, and that will be the trend question moving forward, is what does this $231 billion turn into in 2025 in terms of sales and earnings?
These guys, you know, I mean, they've been spending, Josh. I think a lot of times these CEOs just think I have to spend because if I don't, my rival is going to. And we've spoken to analysts about how long that AI spending is going to keep on for. At least some of them said they don't see a let up in the next 12 to 18 months.
And then you think about a company like Nvidia, right? Who's benefiting from that spend? That's why I put here Nvidia is still the leader. It's all going to Nvidia. But one thing, Josh, I wanted to highlight just from a stock move perspective, this is Nvidia's one-day price move the day after earnings. Right now, the stock is down. It would be the first time the stock has been down twice in a row since before the launch of that popular AI site, ChatGPT. So it'd be quite surprising to see the stock down again a second day tomorrow, second quarter in a row. Right now, it has kind of been incremental buyers come in at some point, so it'll be interesting to sort of watch that action tomorrow. But it does feel like, especially when you think about NVIDIA's revenue right now, finally growing less than 100% year over year, it's starting to slow a little bit. And at what point does that not just immediately get more buyers as it falls is going to be a question, I think, to watch.
And now you've got the call coming up,
Right.
so all attention, I mean, you're going to be hanging on every
Stock
word
moves a lot on the call.
of Jensen Wong. I think key will be, what does he say about demand for Blackwell? Because that's the key question in terms of whether this growth can really continue.
And we're talking about still positive growth, but slowing growth, right? And that is the trend, I think, to watch going into 2025 with all 7 of these companies. Earnings are expected to grow, but not grow as much as the 493. Goldman Sachs translated that into what that means for price performance. So when you look here, Mag 7 have outperformed significantly over the last 2 years, right? Why is that? Their earnings have outperformed. When we spin it forward to 2025, earnings growth is supposed to come a lot closer. That leads to the narrowest outperformance, Goldman argues, over the last 7 years for the Mag 7. So that's a trend right now that strategists think is going to continue going into 2025. Is Mag 7 had been growing. Maybe it slows down a little bit, and maybe we see this broadening of the rally.
So then I'm looking to the other 493.
If you're looking to the other 493 and companies that are taking these NVIDIA chips and using them, right, to monetize, where is that sort of playing out in the market is where people feel like this AI story could go in 2025 instead of just constantly only talking about NVIDIA and those other big companies.
Joshua, thank you. Appreciate it. Stick around. Much more Ask for a Trend still to come.
We're keeping an eye on shares of Stanley Black Decker as investors track its latest Analyst Day, or Investor Day, I should say. Let's bring in a Stanley Black Decker CEO, Don Allen. Don, good to see you in person.
Great to be here, Brian.
I appreciate it. So, Investor Day for your company, what was the message or pitch to investors here as we look forward to next year?
Well, I think, we all know that we're living in somewhat of a volatile world right now. So we really tried to focus the energy of the day on the long-term value creation that exists for Stanley Black Decker. And when we think about the transformation we've been underway for the last 2.5 years, we felt like that it was important to let people know that we're getting to the last phase of the transformation, which is basically taking out $2 billion of cost.
A lot of costs.
Getting our supply chain in a more robust manner, getting our service levels up to higher levels of performance with our channel customers, and in really ramping up our innovation. And so we've made great progress in that regard. But we have one more year to go. And so by the end of 25, we can kind of say the transformation is complete.
Why I liked your latest earnings call, you just reported a couple weeks ago, is you were no BS. You're like, the housing market, it's still under pressure. You laid it out there for investors. Why does that pressure still exist? We've seen a couple rate cuts by the Fed. Like, when do things start to improve a bit?
Yeah, I think, mortgages need to get closer to about 5%. And we're still in the 6s, and when we get there, I actually think it's going to free up a lot of activity around people changing homes. Because one of the things happening right now is that home sales are very, very low, because people are locked in on an average mortgage of around 3%, maybe even less. And so, why would you get a 7% mortgage on a bigger house?
What are you seeing in terms of DIY projects? We've heard the earnings calls from Home Depot. We've got the earnings call from Lowe's. Are consumers taking on larger projects or smaller projects? Like, where are those dollars right now?
They're definitely taking on smaller projects. They're really being prudent with where they're spending their money and how they're spending their money. When you look at what's selling of our products through those types of channel customers, it's the more small to mid-sized things versus the larger products, the big price tags. The things that are up or closer to $1,000 are not moving as fast.
You know, you've heard some of the proposals, potential proposals by the Trump administration. Does the Stanley Black Decker raise prices ahead of any potential tariffs, or do you say, wait a second, we're going to see what happens here first?
Yeah, we're definitely going to wait and see. I mean, we actually have been planning different scenarios since the spring of this year. And so when it became very probable that, you know, President Trump might win the election, you know, we began to really think through what are the different scenarios. And we went after three different pillars, as I've called them. One was, you know, I personally have been spending a lot of time with folks that know President Trump very well, that are kind of in his orbit. I've also spent time with senators and folks in Congress that are in states where we have manufacturing and other operations, just to help them understand how the impact of a new tariff regime might mean to our company and our industry. I've also spent time with our team talking about, okay, well, when day one, when something is announced, we want to be doing pricing actions with our customers of some magnitude. And so we've actually started to have some of those conversations with our channel customers in the last week or two. And you know, we won't do anything until we see something on that says, okay, here's what the new world of tariffs is going to be. And the third thing is we've built a plan around supply chain to continue to mitigate and reduce our China exposure. I mean, 10 years ago, even 8 years ago, 40% of what we sold in the US came from China. Today, that number is about 25%. We're going to continue to move that down, and we were planning on doing that no matter what.
Can you move it back to the US? I'm trying to almost get to with a lot of leaders. Is tariffs good for US manufacturers, companies that make things like you guys do?
I actually think tariffs can be good for the right certain industries. And you know, certain industries are definitely under attack from Chinese competitors. And I think that's really what President Trump and his team is thinking through. They know the auto industry is under attack. They know semiconductors, the healthcare industry, certain other electronics industries where US companies and US manufacturers are definitely feeling the pressure of that. I'm not sure that necessarily applies in other industries. And so in those industries, I think there's a heavy weighting towards US manufacturing and the benefit aspects of that. When I look at our industry, if I took our Chinese operation that we have today that makes power tools and brought it over in the US, the cost to make that product would be about 60 to 70% higher. So it's substantial.
Which the consumer is not going to pay for.
Which the consumer will not pay for. And so if we're going to reduce our China exposure, which we are, we'll be looking at other Southeast Asian countries like Vietnam or maybe Mexico, where we certainly have a significant operation already.
Lastly, before we let you go, I know innovation is at the heart of your company. Talk to us about your move towards electrification. Where is it at in your portfolio, and how important of an initiative is it for you and the team?
Well, it's one of the things that we're really excited about around the innovation that we see kind of going forward and ahead of us. Because, you know, for decades, Stanley and Black Decker, and then together, our company has been working on different categories to electrify the battery technology. And so this year we announced something called Power Shift, which was in basically concrete application tools that are now battery operated. First time ever that you have substantially high performance.
Like a jackhammer?
Yeah, things like that, exactly. Or flattening, you know, the device that flattens the cement when you have to lay it.
How long do you get on a charge?
You can get a charge anywhere from 1 to 2 hours. And then you can obviously quickly change it out with the new battery pack. And there's quick charging stations as well that allow you to recharge the battery quickly. So there's more categories like that haven't been electrified. Obviously there's some in outdoor that are gas operated. There's other ones that are operated through air compression technology. And those are types of things that we just need to keep innovating.
Well, good luck on that journey. It was good to see you. I know you don't do a lot of these interviews. We'll come back to Yahoo Finance. We want to stay in touch with you as you continue along your journey. Stanley Black Decker, CEO Don Allen, good to see you. We'll talk to you soon.
Good to see you. Thank you, Brian.
All right, much more ahead on Yahoo Finance. Do stick around.
Nvidia reporting earnings moments ago. The chip giant's third quarter results topping estimates on the top and bottom lines, but the revenue guidance weighing on investors. The outlook for $37.5 billion, plus or minus 2%. The estimate for $37.1 billion. Yahoo Finance's Dan Howley joins us now with more on what to know. Dan, Nvidia reports. Give me the Dan Howley takeaway. What'd you make of it?
Yeah, I mean, look, it's a blowout quarter. I mean, I think investors are taking some of those wins, and maybe they're just not as stoked on seeing an outlook like what they offered versus, one that was a huge raise or a beat that wasn't 400% on EPS year over year. So I think the expectations are still a little out of whack compared to where they were in the prior couple of quarters, just because they were so incredible. They did say that their biggest customers for the data center was the cloud service providers. So those Microsofts, those Googles, those Amazons, those Apples, the Teslas, these big companies are buying up these chips still. And I think I just want to point out some numbers here as far as revenue goes. They reported a 94% year over year increase in revenue. Data center revenue itself was up 112% year over year and 17% sequentially. So you're seeing that kind of, okay, well, show me more kind of attitude potentially from investors at this point. I think one of the other things that's very important to point out is NVIDIA kind of trying to assuage concerns about Blackwell and any potential delays in shipments. They said that they're going to be start shipping, production shipping in the current quarter, and that's going to ramp into 2026. And so that puts it online to get billions in revenue, as Jensen had said, in the quarter for Blackwell, and then beyond there. So I think that's going to be something that analysts are going to continue to watch. They want to know in the coming quarter or the current quarter how much revenue Blackwell is driving. And obviously they had mentioned, Colette Kress, the CFO, had mentioned that they still are dealing with issues with just getting enough chips out the door to customers because demand is so high. So that's something that they've been dealing with for quite some time. And it appears that they're going to, for the time being, moving forward, just because of how much demand there simply is from, again, these huge cloud providers, as well as other companies trying to get into the space.
Dan, the conference call starts in 4 minutes. Traders and investors are going to be hanging on CEO Jensen Wong's every word. Dan, thank you. Appreciate it. Time now for what to watch. Thursday, November 21st, we're going to be getting some fresh economic data, starting with initial jobless claims for the week ending November 16th. Last week, remember, claims in the U.S. fell to 217,000. That was down from 221,000 the week before. That was the lowest number of claims since May. 220,000 claims are expected this week. Drop in claims shows the job market is strong, even with the Fed possibly tightening monetary policy. We're also going to be getting existing home sales for October. The expectation there is 3.91 million. That would be a slight increase from the month before. In September, existing home sales fell month over month and year over year in the South, Midwest, and Northeast, while sales in the West grew. We'll also be getting another round of Fed speak. Cleveland Fed President Beth Hammack and Kansas City Fed President Jeff Schmidt are both expected to deliver remarks. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.